A pest control technician may spend 20 minutes at a house and collect a payment every month, whether the customer sees a bug or not. The obvious service is killing pests. The more valuable service is maintaining the belief that pests will not return, which turns an emergency phone call into a recurring route. The company appears to sell chemicals and short visits whenever insects or rodents appear. But that picture misses the mechanism carrying the money. Start by removing the obvious object from the description. The real product is monitored prevention delivered through route density, licensed judgment, and a promise to return if the barrier fails. Now the odd fees and operational rules begin to point in the same direction. Now move from the sales pitch to an actual operating day. A lead becomes an inspection. The first treatment solves or controls the visible problem. The customer joins a recurring plan. And a technician revisits on a schedule while handling callbacks between routes. What looks like a single sale is really several operating bets placed in order. The first revenue stream is initial treatments priced for inspection, setup, exclusion work, and the severity of the problem. This line matters because revenue quality is not just the size of the invoice. It is how often the purchase repeats, how much extra work it creates, how sensitive it is to price, and whether the same fixed assets can deliver it again without another large investment. The second revenue stream is monthly, bi-monthly, or quarterly recurring plans that smooth seasonality. The useful question is how much of that sale survives the next required action. A dollar that repeats automatically, uses idle capacity, and needs little support is not equivalent to a dollar won through fresh labor and advertising. The third revenue stream is termite, bedbug, wildlife, mosquito, commercial food service, and property management work. Its quality depends on frequency, incremental cost, collection speed, and what it does to the bottleneck. The largest line can be the least attractive when it arrives with too much complexity. Income explains why the owner gets interested. The other side of the ledger explains whether interest becomes a return. The first cost block is technician wages, training, licensing, recruiting, and windshield time. This expense becomes dangerous when it grows quietly while the sales report still looks healthy. Good operators force it back to the unit that created it. Then there is vehicles, fuel, chemicals, protective equipment, traps, software, insurance, and disposal. The cost is manageable when its timing and cause are visible. It becomes lethal when it is averaged across the company until nobody owns it. A less visible drain is marketing, call centers, sales commissions, discounts, and customer acquisition. Every business has an expense it describes as fixed until volume reveals that it is not. This is one of the places where that surprise tends to appear. Finally, the owner has to absorb free callbacks, seasonality, weather, route gaps, cancellations, and claims when treatment or exclusion fails. A weak operator treats this as background overhead. A strong operator ties it to a driver, watches the driver move, and knows which customer, unit, route, or hour is supposed to pay for it. Suppose a technician carries 200 recurring customers, averaging $45 a month. That route represents $9,000 of monthly revenue before new work. If the stops are dense and planned well, one technician can service the book efficiently. If the same customers are scattered, windshield time becomes the largest invisible chemical in the formula. Reduce churn by 1 percentage point and more of the acquisition spending survives. Let callbacks double and paid capacity disappears into visits that produce no new invoice. Notice what the calculation did not ask: whether the annual revenue sounds large. It asked what one unit contributes and how often the underlying capacity can be sold. A smaller company with clean unit economics can outrun a larger company that buys every new dollar with complexity. Subscriptions create predictable cash, while commissions and first service discounts can make a new customer unprofitable until several renewals have been collected. Cash conversion determines how fast the model can safely grow. Each new sale either releases cash, consumes it, or temporarily disguises an obligation. The owner needs to know which one before celebrating volume. The constraint is often somewhere other than management first expects. Adding the visible asset can make results worse when the real bottleneck is labor, access, storage, documentation, dispatch, or demand at a specific hour. Companies fail when aggressive sales teams create accounts technicians cannot service, routes expand without density, promises exceed the label or contract, and churn is hidden behind constant new customer acquisition. Most collapses are assembled from small permissions. One exception becomes normal, one maintenance task moves to next month, one weak account is kept for pride, and one cash reserve is borrowed. The system looks busy right until it looks broken. The moat is a trusted brand, licensed technicians, dense routes, fast callbacks, property manager relationships, accurate treatment records, and a subscription customers hesitate to cancel. Because prevention is invisible until it fails. Price is visible and easy to imitate. Reliability is built from people, systems, access, records, and repetition. By the time a rival understands every small cause, the incumbent has already served another year of customers. Success creates its own problem. When the service works, the customer sees nothing and may decide nothing is worth paying for. The company must prove prevention without inventing fear. Once this is understood, several odd choices stop looking odd. A free feature, slower sale, smaller customer, empty slot, returned container, or paid claim may protect more value than the obvious short-term margin. Scale improves marketing, scheduling, purchasing, training, and commercial contracts. But adding distant customers can reduce profit even while revenue grows, because geography sits on every invoice. Size can create purchasing power and brand reach, but it also creates distance from the work. The organization must gain more from shared systems than it loses through complexity, coordination, and slower feedback. A serious buyer would ignore the dramatic total for a moment and ask for operating evidence. Show the unit, route, room, asset, or professional that creates capacity. Show utilization, repeat behavior, collections, maintenance, cancellations, and the one expense management keeps calling unusual, even though it appears every year. There is a good business inside the complicated one, but it does not emerge automatically. It has to be designed. The right demand, the right capacity, a price that recognizes the burden, a reserve for what will break, and a reason customers remain. Pest control is a route subscription disguised as a chemical service. The spray matters, but the economics live in density, retention, and the confidence that one quiet month means the barrier worked, not that the bill became unnecessary. There is one final test. Remove the most impressive number from the pitch and ask whether the operating system still makes sense. If the answer depends on perfect utilization, endless price increases, free owner labor, or equipment that never fails, the profit is an illustration, not a business. A resilient model leaves room for a slow month, an expensive repair, a difficult customer, and a competent employee who expects to be paid fairly. Boring resilience is the part that survives after the thumbnail, the grand opening, and the first optimistic spreadsheet are gone. There is one final test. Remove the most impressive number from the pitch and ask whether the operating system still makes sense. If the answer depends on perfect utilization, endless price increases, free owner labor, or equipment that never fails, the profit is an illustration, not a business. A resilient model leaves room for a slow month, an expensive repair, a difficult customer, and a competent employee who expects to be paid fairly. Boring resilience is the part that survives after the thumbnail, the grand opening, and the first optimistic spreadsheet are gone.